Hello once again, this is Dave Knight here at Knight Capital Management. Thanks for watching. We're continuing our eMini Bull Bear Basic, our free method. We're in the tailspin of wrapping this up right now. We're going to take a look at the CCI, part 2 of CCI. We're also going to bring in volume part 1. Look at volume part 2 on the next video and then wrap it all up by putting it all together into a trading method and strategy for you. So we got this video and 2 more to do to complete this, wrap it up here. Last time we looked at the CCI, and I would like to further define this a little bit further. But before we go into this, let's talk a little bit about what we talked about last time. We talked about the ADR. ADR was 1, and the CCI was 2. ADR is the average daily range. And we also talked about the CCIs, which we're talking about today, the Commodity Channel Index. Let's further define the CCI. Now, according to Wikipedia, the CCI, or the Commodity Channel Index, it's an oscillator first introduced by Donald Lambert, first published in an article in October 1980 in Commodities Magazine, now known, you might have heard of this magazine before, called Futures Magazine. It's I'd recommend this one, and sometimes you might be able to find a free subscription to get started in futures. Now it does have a calculation involved in it. P for price, S for the SMA, and this little funny letter right here is the lowercase sigma. You might have seen this in another way, shown like, once again, you might have seen the sigma shown like this, the capital Greek letter. I might have seen it on some dorm frat houses perhaps as well. Let's not get thrown off of what the lowercase sigma means. It's the mean absolute deviation, and we're not going to get involved in this particular calculation. We're just going to take it for granted that it works. The CCI is often used for detecting divergences. We talked about that before. And one of the things that I want to point out that we kind of use differently, but just so you understand the definition, large probability that a price will correct to more representative levels. There's areas that are of important are the overbought area, which you see the red lines through here, and the oversold areas were represented by the blue lines below. Now the CCI typically oscillates between above and below a zero line. Normal oscillations will occur between the plus 100 and the minus 100, and readings above the plus 100 are overbought and minus 100 are oversold. Please don't get me wrong, I believe the CCI calculation is a very important component. If you are mathematically inclined, please take a look at this to your heart's content. But what did we learn about it when we bring it back to our charts here? We see that we got the Christmas tree colors going on again. We know that this is overbought areas through here, and through here is your oversold areas. So we have our overbought up through here and oversold. Let's bring this into the price chart itself now. So now we're looking at the CCI, and we're also looking at it into a price chart. Now we see it's below our price charts. This is a normal place that you'll see it on charts, not into the chart itself like the Bollinger Bands. But this is another way of looking, and perhaps another way of looking at a Bollinger Band perhaps. We talked about previously, we talked about the 50 MA, we talked about the 200 bar MA, we talked about our upper average daily range, we also talked about the lower average daily range. Now all this is important. We talked about the trend, we talked about the counter trend. Now we know where the most important areas are according to the CCI is right through here. It means oversold, which was all this line right here, overbought up through here on this line, again oversold through here, which is right in here, overbought through here, again through here, and overbought again through this area. Now if you simply look at the definition itself, this area through here is an overbought condition, and this is an area that you would miss out on. According to the CCI trade itself, you would not catch this move. So sometimes the overbought condition can be counteracted by a nice move, in this case a counter trend move, and you can see a nice trending move through here, through the CCI index in your trading strategy. So we use the CCI a little bit differently than maybe the pundits use it, as I would call it. So if we're looking at this area here, just on the crossovers of the 50 bar MA, we can see that we have an area through here We got an area through here, and we have a couple areas through here that maybe performed a little bit of a loss here, and we have some areas through here that have a nice area through here. So looking just strictly at the crossovers on this bar, we can see that we have some strong indications of perhaps a nice trades that were set up during this November 30th day. Now nothing is perfect in this, and even though we saw the CCI, we also know that everything can form a loss, but we're looking for high probability trades. So what we need to bring into this is one more area that I really recommend in my trading, and that's volume. So let's take a look at volume at its core concept. Now on my charts you're going to see it shown like this, now obviously not this big, but I wanted to blow up the volume. So now let's actually remove all the fancy indicators here, and let's go back and take a look at its core concept. At its base, volume represents a level of what kind of contracts have been moved, both buying and selling throughout the trading day. And you can see this represented by a 5-minute bar that we see here. You can see it represented by a daily bar, by 30-minute, and so forth in the futures. Now, one of the advantages that we have in futures as opposed to Forex is that we know what the volume is. This is what I believe a key, and we'll just leave K for key, to your success as a trader. T for trader. We can try to print this out. There's a freehand trader right there. On our next video, we're going to bring volume into the price chart, just like we brought the CCI. But we're going to take a look at part 1 of volume today. So what we know right now is the volume. We can see that high volume through here, by the way. We can see it above this area. In this case, looking up at roughly 127,500 contracts at 4 o'clock, which is right around the close of the market here, 4 to 4:15. Now, just like we used the moving averages up in the other area, we want to look at a moving average of volume. Now, we know we're not going to have any negative volume, so basically it's just a matter of how up the volume is. But we can define this volume by showing this as a dark red line and try to see where the average volume is over, in this case, maybe a 4 or 5 period time. And this will help you determine. Now we see some areas that perhaps it's over the red volume. You see here and here. Like through here, we can see that's certainly through there. Up through here is all, right through here. There's another area that's above. Another area above right there. Some areas through here. And obviously we see some areas through here. So if we would add one other concept here, our green volume bar, we'll see where this is significant. So now we brought in our green volume, and we can see where our volume is above, and this gives us some trading decisions. With the other, if we just would straight, oh, we want to buy, sell, we don't really know what to do on the volume here. But what we know about the green bar volume is it gives us a kind of a green light to perhaps take on a trade. And we see all kinds of areas that we can be looking at as it relates to trade. Now, we're going to combine this into our trading areas. You can kind of figure out what we're going to do on this next video. We're going to bring in how to trade this on the 50 bar MA. We're going to learn how to trade with the CCI, and also bring in our volume as well to help us make high probability trades. HPT, let's just call it high HPT, high probability trades that actually end in more of the W's than the other area that we like to call losses. So what we're looking as an overall trading strategy is to be this: win our trades more than we lose. And that is what we're working with this trading method. On our next trading video, we're going to bring in the whole volume into the price charts. We'll review a little bit. We're bringing volume in the price charts, and then we're going to wrap it all up in our next video. So we have 2 videos left. We're going to put the volume back into the trade, and we're going to show you how to take a look at volume and maybe what's a good trade, what's a bad trade in volume as well. This is Dave Knight here at Knight Capital Management. I wish you the best in your